Greetings, Professor McKee here with our next seminar Saturdays. This week we're going to be talking about tax policy and trick-or-treating, but mostly just the trick part. Our paper today is called Taxes and Corporate Policies, Evidence from a Quasi-Natural Experiment. I promise we sometimes have fun titles, but a lot of them can be kind of very, what it says is what it says, like this one. And my standard disclaimer about names, I apologize for any mangling that will happen. This is published by Craig and Doidge and Alexander Dyck in Journal of Finance 2015. So a few introductory notes. This paper is set in Canada. Most papers focus on US markets, not foreign countries. And there's a few reasons for that. The U.S. market is pretty large. We have a large number of companies. We have the largest market capitalization, so there's more stuff to look at. U.S. has a pretty stable financial market with a long historical track record. We tend to have very good data collection and very clean data, so it's easier for us to actually find out things when we're trying to do research. And of course, most research schools are in the United States. Although these authors are actually in Canada, they were at University of Toronto when they published this paper. However, if there's a good natural experiment and they have a really good one, we will go to foreign countries, even though Canada is not that far away, because wherever those natural experiments are, we finance researchers are going to rush over there. So, our question today is if taxes matter. Well, yeah, of course they do, right? I mean, of course companies will respond to tax policy changes. If you raise taxes or lower taxes, they're going to do stuff in response. But empirically, do they actually do it? And assuming they do, how much does the taxes matter? And this is a pretty standard, hey, theory predicts that companies care about taxes. Let's go out and see if they actually do. Also of perhaps some interest in terms of how much do taxes matter. Well, if you're a government and you're trying to decide your tax policy, you might be interested to know how much your tax changes will impact the companies you're taxing. So, our authors have a really interesting and really good, in terms of identification strategy, natural experiment to explore these tax policy questions. Before we get into their actual paper, let's talk about some of the theoretical predictions that they are going to be testing. So if we have higher taxes, that is going to reduce net income for the companies because they're paying income tax expense, that's higher. For instance, let's say we have a 100% tax rate. That means all income is going to get taken by the government. That means the owners of the company receive exactly zero of cash flow from the company. So the value of the company then would be zero. There's no point in owning the company if you're not making any money at all from it. And there's no chance of it because the money you do earn is being just taken all in taxes. So if we have a high tax rate, but it's less than 100%, that's just going to make the company less valuable than if we had a lower tax rate, but there's still some value. Now, companies can protect some of their value with tax shields. So, if we increase taxes, the things that shield revenue from taxes are going to become more valuable, which means companies will use them more when taxes are high, and they're going to use them less because tax shields aren't free when taxes are low. Pretty straightforward. So what tax shields are we talking about here? Well, the first one is the one we teach all of our students in the introductory class for undergraduates and in the business school, which I am teaching several sections of that this semester. It's interest expense. If we have high debt, that'll reduce our tax income because we deduct our interest expense from our revenue. So interest expense debt is the primary tax shield that we talk about in finance. But there's non-debt tax shields as well. The authors define it as being depreciation and amortization, because these are also expenses you can deduct from your revenue. And they base that off the accounting literature, previous finance literature. Depreciation is somewhat flexible in when you take that depreciation and amortization as an expense. And in theory, any flexible expense that the company has some discretion about when the expense is incurred, how much they count as an expense, and that sort of thing, all of those could be used as a non-debt tax shield. The authors are going to focus only on depreciation and amortization, and really they focus mostly on debt. And exactly how all these sorts of non-debt tax shields work, that's kind of a more advanced topic. That's also a good topic for my colleagues over in the accounting department, because they do research too. Now, tax shields aren't free. Take debt. You have more risk of bankruptcy if you have more debt. You also have potentially other constraints. Maybe the creditors will impose some covenants in the loan contract. Perhaps the creditors are worried about risk shifting, and they say you're not allowed to do certain types of investments or other things as a condition of the loan. So you're paying for this tax shield. It's not a free lunch. A few other things the authors are going to look at are things like payouts, dividends and share purchases, cash holdings, investments, see if those also change. These are often going to be sort of a second order effect, so we increase debt or not in response to tax shields, and then that might have a knock-on effect on our payouts, our dividends, or cash holdings, investments, that sort of thing. So a few predictions here. If tax increases, value will drop. They will use more tax shields, which means more debt and more non-debt tax shields. And potentially second order effects of dividends, share purchases, investments, cash holdings. The authors, at least in their introduction, say the theory is not clear on which direction these last things might go. Now, let's talk about Halloween. So, if we have an ideal setting for tax policy changes, what we would like to see is our government changes the tax rate. It is a large change to the tax rate. It is for random companies, and it is a sudden change, so the companies can't anticipate it. Also, it needs to only change the tax rate, not a bunch of other stuff also that might impact their choices. This is a fantasy. When governments make tax policy changes, what actually happens is they slightly change the tax rate, maybe a few percentage points. They change lots of other things at the same time. It's not sudden. It happens after many months of negotiations in the legislature, assuming there is a legislature, or whatever government body is deciding this. There's going to be a lot of warning for companies to anticipate our tax rate changes here. And it doesn't affect random companies. Governments just don't seem to like randomized controlled trials very much. They like affecting everyone all at the same time. These all create problems for us because basically the tax change happens. There's lots of other stuff that could also be affecting what companies do. All companies are affected at the same time, so we can't really see how companies respond differently because they're all responding to the same thing. Most tax changes are useless for us. Right? There's other reasons they might be useful, but not for us researchers. But Canada decided to be nice to us, and Canada gave us a wonderful, wonderful natural experiment for tax policy changes. October 31st, 2006, Halloween. Canada's Minister of Finance announced that a specific type of corporation, income trusts, more on those in a minute, would be taxed like a normal corporation of a tax rate at the time, basically 31.5%. Before the announcement, income trusts had a tax rate of 0. They weren't taxed. They had no income tax. So they went from 0 to 30%. That's big. There were no other changes made to the tax code for anyone, as well as for any income trusts. And it was a surprise. The newly elected conservative government, they had won the election earlier that year, had campaigned on not changing tax rates for income trusts. This one, so the authors list out some news articles. They do their homework here, Factiva searches of news articles to show that it was a surprise. And a little bit of further confirmation here. There was a huge decrease in the Canadian stock market the next trading day. Stock prices fell about 15% for income trusts the very next day that the stock market in Canada was open, which that's huge. 15% drop in a single day is a very, very large drop. It's extremely rare to see that happen, and it's also a signal that this was a surprise. We do have to be a little bit cautious about interpreting single day movements like that, because it might not be a surprise. And even when you see a big piece of news that affects a single company or a group of companies, sometimes the reaction of the market looks different than what you would expect. Sometimes, for instance, if you have bad news, the stock price actually goes up. And typically it's because the market knew something bad was going to happen. And the reason it goes up is either there was uncertainty about how bad the bad thing was going to be, and now you know how bad it is. So that risk is gone. Now you know how bad it's going to be. Second, the market hasn't guessed an estimate of how bad it's going to be, and then the news comes in, maybe the badness wasn't as bad as the market thought it would be, so market goes up. But a big drop like that does signal that the market was expecting something very different from a 30 percentage point tax increase. Something better. 0% is quite possible. Now, this tax increase is fully phased in 2011, so they get to keep the 0% tax rate through 2010, and starting 2011, they're taxed like a regular corporation. So they have 4 years to switch around things, to adjust. And our authors are going to be looking at what they do during that adjustment period. So in 27, 28, 29, and 2010. So besides income trust not necessarily being random, this is pretty much the perfect setting for us. It was a large tax rate increase. It was only a tax rate increase. It was a surprise. It affected only some companies. And in fact, income trust, because of how permissive Canada was before this massacre, this trick that the finance minister played on them, there was a very large number of companies in Canada who were income trusts, pretty broad in terms of industries and operations. So that's kind of would be your biggest concern as well. There's something about income trusts that are different from all other companies, and then that's why they respond differently to tax increases. But I'm not super worried about that. As we'll see, the income trusts were a pretty big part of the Canadian economy, pretty widespread. And the setting is just so clean. You can always find things to nitpick, but this is a real nitpick in my opinion. Now, income trusts could be unique. We might not be able to extrapolate conclusions about them across all companies for smaller tax increases, but yeah, it's a limitation of any identification strategy. We get the causality. We were able to try to actually look at causality, but we're usually limited in how much we can extrapolate, which is one reason why having 5, 6 different papers all using different settings is useful, because then we have a bunch of different specific cases that we can sort of combine together and do more extrapolation. So what is an income trust? Well, this is a special sort of tax treatment corporate structure, and it exists in a number of countries. There's a number of companies in the United States, for instance, that have this income trust status. They're not usually called income trust here, but they effectively are the same. And the way it works is you accept some limitations, and in exchange, you have reduced, or in Canada's case, no income tax for the corporation. Now, there are 2 common restrictions. The first one is limits on the type of operation that your company does. So, for example, there's something called a real estate investment trust, which is structured like an income trust. They're called REITs. They exist in the US, they still exist in Canada because REITs were not affected by this income trust change. And they are, as the name might indicate, required to invest in real estate. And then they earn rents from renting out their property, and that's how they make their money. Another place where this commonly shows up, at least in the United States, is a trust format where you have to be involved in some type of resource extraction. So one example is midstream energy companies. So oil or gas pipelines that they operate. Companies in the United States tend that do that are often structured as an income trust. Now, the other rule is that almost all income must be passed through the investors as a dividend. 90%. That is our most common cutoff. And so you're basically just taking all of my income and you just immediately pass it through to the investors, so you can't reinvest it. These companies are not allowed to do reinvestments. Now, investors pay dividend tax on this pass-through income. So in effect, what's happening is normally a company gets taxed with their corporate income tax, and then through capital gains tax or dividend taxes, the money that they transfer to their owners gets taxed again. But with the income trust, they get taxed once. The dividend tax applies, and that's it. So there's a big tax advantage for the owners of these income trusts. All right, so how did trusts respond? Well, they basically died out. They went extinct. So the number of trusts in Canada fell by 91%. They were at 166 in 2006. They fell down to 18 as of 2011, the first year the tax increase goes into effect. The market value, this is in millions, so there was 250,000 millions. Mental math is hard. I'm not a math major, or I was. I was a math major. That's why I'm bad at mental math. That's what calculators are for. So this is their value as of the end of 2006, so right after the announcement, and it goes down to 10,000 million, so very huge decrease in market value. At the time, they were actually almost 13% of the total Canadian stock market. And after this happened, they fell down to less than 1%. Now, if you note, they started out at less than 1% as well back in 1996, and there was a pretty big run-up as companies started realizing this is a really great deal for them. But basically, trust disappeared after after Canada played that nasty trick on them. And how did they leave? Well, a lot of them left in 2010, the last year before that big tax increase, which is another kind of sign that, yeah, they're making a strategic choice here, anticipating the tax decrease. This wasn't some other thing, because that other thing would have to be something that only goes into effect in 2011. So about half of them that left, all left in the same year, 2010. If it was just something that made trust less attractive overall, you'd think they would start leaving right away, and it would be or more evenly spread out across all the years. But no, when you see that kind of clustering in this single year, that's telling you they're anticipating, they're doing a response here. Another interesting thing is most of these last ones are conversions. Meanwhile, at the very start, there was a bunch of acquisitions. So these companies got acquired by a non-trust company, and then they are no longer a trust company because their new parent is a regular corporation. So at the start, there was a bunch of acquisitions, and then in 2009, 2010, especially 2010, the companies started converting their structure. And a lot of the value was in here too, so it wasn't just like a bunch of small companies. 50% of the total trust market cap was leaving in 2010. This is a kind of a duh result. I think this is the paper my advisor, who was teaching the seminar class I was a student in, said, this paper should get published in the Journal of Duh, because obviously this is going to happen. But it's always good in terms of research to have confirmation that the obvious thing is really true, because sometimes it's not. And it's also a good reminder for us that firms will anticipate tax changes. They will do that kind of clustering to fully exploit that 0% tax rate and then shift out once they no longer can get the advantage. If they can, if it's not a surprise. That's why surprises are important. Now, their data sources are a little bit unusual because they're not using US companies. So for all their stock returns, their market capitalization, their trading volume, that are things they'll use, they use data stream, which is pretty much the standard one, I think, for non-US firms. CRISP is the standard one if you are looking at US stock market. WorldScope was what they used for the company characteristics, so things like financial statement information. And CompuStat, that's the standard one for us in the United States. And when they look at mergers and acquisitions, they use the SDC. That's pretty normal. I've used it for papers or projects of my own. So nothing super exciting with their data sets beyond they're using stuff, not CRISP CompuStat, but just the global version of them. So first of all, is this really a surprise? I mean, they had the articles, so they had some anecdotal evidence that this was a surprise, but a lot of times stuff leaks, government decisions leak. The nice thing for us is the Conservative Party was not in power until early 2006, so probably there were no plans to do this tax increase until they actually took office. Also, they were campaigning on not increasing taxes, although, politicians, how trustworthy they are, is a thing. Because the reason we're worried about this is if firms knew in advance that this tax increase was coming, they could start adjusting their tax policy or their corporate policies before the announcement. And that would invalidate our results because we don't know if that increase in debt, assuming we find one, is because of the Halloween announcement anymore. They might have increased before the Halloween announcement, and then that's what's going on. So what they looked at is if there's abnormal trading volume. Because obviously a huge tax increase is going to be impactful on these companies, and there's going to be a lot of people making trades if it were to be leaking out into the market. They did find abnormal trading volume after the announcement, but they didn't find any before the announcement. They go back like an entire year. So before even the Conservative Party won the election and took power. So further evidence that it was really a surprise. Good to see. Now, the first thing to look at is market value and what were the returns for these income trusts. And what they did is a pretty standard approach for an event study like this. They have a calculation for the cumulative abnormal return, CAR for short. This is really common. CARs are used all the time in papers for a negative or positive event like this. And it's usually over a relatively short window. So you usually see CARs over 0 to 2 or -1 to 2 or 0 to 10. Very short-term measurement here. You don't see it for long-term, like a year or more, very much. And it's abnormal, which means these returns are being adjusted for overall market movements. So if the overall market moves up, that's going to drag everyone's up, including the guys we're looking at. So what you want to do is control for that and see what was the abnormal movement of this single company or group of companies. And so what they find is, not too surprisingly, the abnormal returns of these companies are really bad. So day zero, the very first trading day after the announcement, all trusts had a negative 18% drop in their stock price. Their estimate of value, which is, you can read about it in the paper. I'm not going to go into too much details. A 10% drop in value. And this is true for business trust, which is sort of just the catch-all category of everything besides the resource extraction, oil pipeline type companies. And same for energy, oil pipeline companies. REITs also went down a little bit the first few days because the conservative government didn't say if they were going to do this to REITs or if it was just all other trusts. And they eventually clarified that they wouldn't, and that is why the authors think there was no abnormal return after that 2-day window. So their 0 to 10 window, nothing happened. And REITs had a much smaller decrease, probably because there was perhaps leaks or other information that indicated REITs were probably not going to be affected by this tax increase. But you can see even out 10 days, it's still going down. It's even going down higher now. Now it's up to 18% drop in returns for these income trusts. It was a really bad couple of weeks if you were invested in the Canadian government, Canadian market, especially if you were in these income trusts. Okay, so value goes down. It goes down quite a lot. Somewhere around 10 to 15%, depending on how much you believe that their particular measure of value versus the stock market returns. Okay, so before the tax changes, trust had a really good tax shield. So after this change, did they start using more debt? Were they using less debt ahead of time, and then did they switch to using more debt? Now, when we're looking before the announcement, we have to be cautious because becoming a trust was a choice. And it might be the case that firms that don't value debt very much for various other reasons might then choose to become a trust. So their low debt pre-announcement, pre-Halloween, is not caused by being a trust. Now, afterwards, we're on much firmer ground if we're going to believe in causality. So if they start using more debt afterwards, we can say, okay, that's because they lost their tax shield. But they do look before just as sort of kind of a triangulation validation of what they're seeing after Halloween. So before the Halloween, what happens? We have less debt. We have higher payouts, less cash holdings, and less investment. Now, these are all correlations, not necessarily caused by becoming trusts, but they make sense, right? So you have a tax shield because you're a trust. Why would you borrow? I mean, you still might borrow some, but you're not going to borrow purely because of that tax shield. Borrowing becomes more expensive for you. Payout is sort of structural, actually. This is probably caused by being a trust because they're forced to pay out. They have to pay 90% plus of their income as dividends, otherwise they get taxed. So obviously they're going to pay out. And you can see the T-stat here is 10. Statistically, this is extremely strong. And that's because, well, there's a law forcing them to do it. So of course they are. Cash holdings, that goes down. The explanation for that is basically, hey, look, they have to pay all their cash out as a dividend, so they can't retain earnings and keep cash on their balance sheet. So they have fewer cash holdings. And then investment, they're borrowing less, so that's one source of cash for investment. They're retaining earnings less, a lot less. So of course they can't reinvest. And those are the two biggest sources of capital for investments. And typically those are also the cheapest source if you're not an income trust. So nothing super surprising here. Again, this is kind of a duh, but on the other hand, we don't know for sure. It's good to have it confirmed. Now, after that nasty trick on Halloween, let's see what happens to debt. So the dependent variable here is leverage, which is debt scaled by their firm size, their total assets. And The variable we care about here is this trust dummy. So if this is a value of 1, then they're a trust, otherwise not. And so the coefficient here is how much trusts increased their leverage following Halloween. So about a 1 percentage point change here. And it's very strong statistically. So yes, they increased that. And another interesting thing they do is they look only within income trusts. So here in columns 1 through 3, they're comparing trusts to everyone else, all the companies that aren't trusts. In columns 4 and 5, they're taking only trust companies and they're comparing them based on pre-existing tax shields. So if they already had debt or non-debt tax shields, and there's two different specifications of this, is there a change in debt there? And sure enough, which is very interesting, I think very, very strong evidence in support of what we think is going on here. If the income trust already had tax shields, pre-existing tax shields in 2006, they don't increase that. In fact, they decrease that more. So this increase is completely outweighed by the decrease here. So trusts that needed a tax shield, they increased that. Trusts that did not need a tax shield, because they had other sources beyond debt, actually reduced their debt in response. So I think this is a really great test here that they've done, a great result for them, because it really shows, yeah, they're increasing debt, and it's very likely to be because they need that tax shield. If they don't need the tax shield, they don't increase debt. Other things that happened. So payouts. Payouts go down if you're a trust. Cash goes up. This is somewhat mechanical because if you're paying out less, what happens to that cash? Well, you keep it on your balance sheet. Also, investment goes up. So again, if you're not paying out cash, also if you're borrowing more money, you're going to have lots more cash in your balance sheet. You're also going to have lots more cash to invest. So you're going to start doing more investments. And, so the second order effects here are they pay out less, they pile up additional cash, and they start doing more investment. So it seems like, at least for income trusts, because the impact on their payout might be relevant in terms of why they're behaving like this in response to tax increase, is, hey, if you want companies to invest more, raise their taxes on them, or don't let them be income trusts to avoid taxes. Force them to borrow to avoid taxes. In terms of mergers and acquisitions, pre-Halloween, there's some predictions. Trusts have a tax shield. This increases firm value. This makes them more expensive, so it's harder to acquire them. Also, because you're more expensive, it's easier to be the acquirer. A lot of acquisitions are done using your own equity. So you issue more shares to raise money to buy the firm you're acquiring. Well, if your shares are more expensive, you can make more money and with the same number of shares. So the pre-Halloween prediction, which again, not causal here, remember that, is they're going to be more frequently acquiring, and they're going to be less frequently the targets of an acquisition. Post-Halloween, their value is going to drop, right? We saw that huge decrease in their stock price. That means they're cheaper to acquire. So more acquisitions done. Also, they might have an incentive to acquire firms themselves, either as a sort of reverse merger, a method to convert to being a non-trust company. This is an approach that companies sometimes take. You've got a company, they want to change maybe the country they're in, or they want to not be a trust anymore because it's not going to help them anymore with taxes. And they go to a company that is in the country they want to be in, or has the corporate structure they want, and they do a merger. And while technically the company that has the desirable attribute legal status is the acquirer. In practice, it's different. It's basically, we call it a reverse merger. Another reason you might want to do these acquisitions is, hey, at the time you have no debt, maybe you have no tax shield. You can go buy a company that has lots of debt, and now you've gained a tax shield. On the other hand, you've also lost a lot of market value, which makes it harder for you to do acquisitions. So, maybe there's more acquisitions, they could benefit from it, but maybe not, because maybe they just can't do it. They've been hammered by this trick, and on Halloween, they can't afford to do acquisitions anymore. And we do predict, however, that they're going to be the targets of acquisitions, because they're cheaper now to buy. And the companies that buy them, if they're not a trust themselves, will then take all the assets of that income trust and put it under a corporation structure that has better tax shield protection. So it's actually kind of more efficient for investors and companies too. So what happens with the M&A activity? Well, pre-Halloween, our predictions are exactly what Craig Doidge and Alexander find. They find that the trust dummy here, which compared with the trust dummy interacted with our post-tax increase trick, they have a negative coefficient here. So companies before Halloween are less likely to be the target of an acquisition. And both, they add a bunch of controls here, and it still stays. They are more likely to be the acquirer, again, pre-Halloween. So those two predictions, we find evidence for them. Now, the interaction here is we're a trust company, and it's also after Halloween. So they are targets more often. There's an increase here, and it's statistically significant. Pretty good T-stats. As an acquirer, nothing happens. This is a null result. So there's no evidence that they acquired more, but they after the Halloween, but there is evidence they were the targets more often. And we don't know exactly why they didn't acquire more. Could be those two theories counteracted each other, or maybe they were just both not really the case. We don't know. We can't tease that out. Okay, so there was a number of robustness checks that they also add in this paper. This is a much longer, I wouldn't call it bloated, but there's a lot more robustness stuff that they throw in both in the main paper as well as an internet appendix. I will include a link to their paper. You can go check out those additional tests. There's also some work they did involving the effect on the investors of the company, because investors of the company, now there's going to be double taxation, which makes it worse for the owners of these corporations. So there's some discussion of that too that I've completely skipped over. So check out their paper if interested in that. The link to it, at least for SSRN, will be in the video description. All right, so in conclusion, we have found taxes do matter. Firms pursue alternative tax shields, namely debt, when you strip away their other tax shield, the income trust structure. Also, they will abandon useless legal structures like this that restrict them if they don't receive a benefit for it. Their dividend payouts were down. Their cash holdings were up. Their investments were up. And therefore, because of the debt increase, the capital structure that we teach in intro classes has been confirmed. We tell our students, yes, companies like using debt because it protects them from taxes. And sure enough, we increase taxes on these companies by a lot. We see them raise their debt a lot. So, theory confirmed. All right, and that is everything for our seminar today. Next week, I think I'm going to bring in a much more recent paper, one that I saw presented at a conference earlier this year.